Don't use your equity accounts as a waste bin for transactions you don't know how to code. If there's been an auto withdrawal from the bank, or if you've made a disbursement, there's a miscellaneous receipt, don't just record the offset to cash in retained earnings or draws just because you don't know how to properly record it. It makes things extremely confusing. One, retained earnings won't roll from the prior year because you're changing that balance. Two, significant transactions could be masked in the process. If you purchased a major piece of equipment, that asset addition could be recorded in draws in error, but you don't even know that until the CPA goes and cleans it up. It throws things way off. And in that process, it confuses the users of the interim financial statements. They'll start scratching their heads wondering what happened to prior year retained earnings, expecting it to roll from the prior year. So these are reasons why you shouldn't do this. So, how should you use the retained earnings accounts? Well, to understand that, you have to know how the balance has changed. Retained earnings or your equity accounts are just prior year earnings and losses rolled from year to year. If this is the first year of operation, you have no balance in retained earnings. But if your income is $20,000, your equity next year will be that $20,000. So it should just be an accumulation of earnings from year to year. How these balances change. It's typically an automatic entry made by the accounting software. It closes all of your income statement accounts to retainings for you. So once you roll into the next fiscal period, it does the work for you and creates a balance in that account. How to properly use retained earnings or equity. If you need to record a prior period adjustment, you record the journal entry to equity. If there was just an error in the prior year that it should affect only the prior year, well, you're going to record that through a journal entry to retained earnings. Another entry that's commonly made is an entry to close out prior year draws and distributions. Draws and distributions accumulate year to year. They roll from year to year just as any balance sheet account does. What a lot of people like to do is close them out to retained earnings so that the only balance that remains is from the current year activity. Draws and distributions account, as I just mentioned, just includes the prior year draws and distributions, including the current year draws and distributions. How the balance changes, you record transactions through different modules, cash receipts, disbursements. You can go to either one of those modules and record that activity as either a cash receipt or a disbursement. A disbursement when it's a draw to the owner, a receipt, maybe it's a contribution. Some people like to keep a separate account for contributions. For the most part, you can just have one account that includes both. How to properly use this account. Anytime the owner draws money from the business or spends money for personal items, it should go to that draws or distributions account. If there's a subscription to Netflix and there's no Netflix streaming in the waiting room, well, that's a draw to the owner if he's got it at home on his screen. So that's how you would record that. Another way is, as I mentioned again earlier, closing out draws from the prior year to retained earnings. Those balances roll forward year to year. If you want to just reflect the current year activity, you'll record essentially a reclassifying entry to move prior year draws from that account to retained earnings. To close out, if you don't know how to code a transaction, ask your CPA first. This is typically the best approach. If you don't know how to record an asset acquisition or a significant transaction, ask your CPA. You're likely to get a timely response for that entry so that you're not throwing off the users. The next best step is to record the transactions to an Ask My Accountant expense account or income account, some income statement account. But whatever you do, be consistent. Record all of those entries to the same account. It makes things extremely complicated when you choose multiple accounts and it's inconsistent. As I mentioned earlier, you could be hiding significant transactions within these accounts. So it's best to know upfront, and there's no surprise down the road as to how that affects either the income statement or balance sheet. I hope that was all helpful. Please let me know if you have any questions or comments. Thank you.